All right, let's get started. Welcome, good morning, good afternoon, wherever you're joining from. Thank you so much for coming here today and joining us. We're so happy to have expert advisor Jay Wilson back. He's back with us for the third time this month. And today we're going to be talking about the financial statements and the financial reports. Like Jay had mentioned, based off of what he has created thus far. Through his presentations on QuickBooks. So this will be a nice opportunity to kind of tie it all together here today. Throughout his presentation, if you have any questions, please feel free to send them our way. You can do so through the Q&A functionality in Zoom if you're joining us that way. Or you can ask your questions through the commenting on our Facebook group if you're watching us that way as well. Before we get started, I just wanted to take a moment to introduce ourselves and PCV for those of you who are not familiar with us. Pacific Community Ventures is a nonprofit dedicated to the support and success of small businesses. Our mission is to invest in small businesses, create good jobs for working people, and make markets work for social good. We do this through our fair and affordable lending program, our free business advising program, and our research and consulting team. If you're not already involved in our business advising program and you'd like to be paired with an expert advisor like Jay, I encourage you to sign up. I'll share the link and information after this call. Jay, like I mentioned, he's back with us for the third time this month. He is one of our expert advisors in our PCV community. He has a passion for empowering new and small businesses, and he has the accounting and tax knowledge to back that up. He's been joining us this month for our Summer of Financial Empowerment, and we're so grateful to have him again here today. All right, so Jay, I'll turn it over to you. I'll stop sharing my screen so you can if you would like to. And I'll let you kick us off.
All right, everybody. Thanks for joining me on a Saturday. Hopefully, I caught you all when you're not busy with your own lives, and you have some time to go over some fun stuff. The last couple of webinars were about getting things into QuickBooks, and now we're at a point where we're actually going to be able to see what we put in throughout the month, and now at the end of the month, we will take a look and we'll see how the financial statements relate to one another. And the best way to do that chronologically is with the income statement, and then we'll flow into the balance sheet. The income statement is also referred to as a profit and loss. Those two terms are used interchangeably. So the way the income statement works, or the profit and loss, depending on who you ask, is that statement is a time frame, a specific from date and a to date, and then it's looking at the total events that took place within that time frame. And that's distinguished from the balance sheet, which on the balance sheet, you're only looking at a particular exact point in time, an exact date, and you're looking at what are my assets, or as I explained in the previous webinars, the resources, compared to the liabilities or the debts or the interests of either third parties that have assisted by providing resources, or the owner's assistance to the business himself or herself. So we'll start with the income statement. Like I said, we've already reconciled, hopefully, for the end of the month, and we did that in the accounting tab on the left there. And we've already been through our banking tab. We did that before we reconciled. So now we're at the point where we can go to the report tabs here. And we're going to run a report. Now, of course, there's a litany of different types of reports that you can pull. They're all kind of derivations on one another. As you can see, there's a lot of different profit and losses here under what it says business overview. For all these different types, feel free to play around with these. The names are very intuitive. So once you know kind of what a profit and loss is or a balance sheet is, you can kind of see how these will help you achieve various informational goals that you want to achieve. So we'll just start easy, and under standards, there's favorites, and it just says profit and loss. So let's start with the profit and loss here. Go ahead and click on that one. And let's see if we can get to our filters. Here at the top, it says accounting method, and it's distinguishing between cash and accrual. Accrual is a fancy accounting term for when you have outstanding invoices to customers. Say you let your customers wait to pay, then you'll have accrual issues on the income side, or if you have bills coming in for your vendors or suppliers or service providers that you pay to perform services for your business, and you have these outstanding bills and those bills have not been paid yet, that also will create a difference between accrual and cash. The easiest thing probably, and at least when you start a brand new business, is to look at the cash and just look at the cash flows either to or from the bank accounts or the credit cards. But if you already have invoices outstanding for customers when you're starting a brand new business, or you already have bills that you wait 2 weeks, 30 days to pay to your vendors or suppliers, then the accrual report might be better and more informative from the very start. So feel free to run both reports. It's pretty instantaneous, whichever one you select. And like I said, the cash one just excludes the invoice amounts out to customers or the bills that have yet to be paid to vendors, suppliers, or those that you pay expenses to. And we're going to want to make sure our report period is right, because remember I said that the report period is looking at a particular point in time on the profit and loss. So we're going to look at the month, and let's assume it's August 31st here. It's not quite the end of the month, but almost. So we're going to click on last month, and it should show the previous month. So since it's not the end of the month yet, it's just showing July, so that's okay. Let's run the report for cash for July and just kind of see how that looks. And as you can see, we have income coming in, but this design income number, for example, this is a design business. This design income number is the actual cash that's been received, that's been collected already from customers. That's what's going to show up here. And then if you run accrual, hopefully our example, yeah, so our example has invoices outstanding and customers are paying them as they become due, these invoices outstanding. So you'll see that when you run an accrual report, the design income is going to be different, because this 2250 is including outstanding invoices that have yet to be collected from customers, whereas this cash report is going to show only the cash that has actually been received, invoices that have actually been paid already. So there's an example of the difference there on the income side. So the accrual report is showing, like I said, the invoices outstanding, and it's also going to go by the revenue drivers, or what's coming in from the customers, and then it's going to slowly take out the various expenses. It starts with any discounts, and then it runs to the products that needed to be paid for to provide the service. So again, this is a landscaping or design business for outdoor landscaping. So it has all these job materials. These are absolutely necessary to provide this service to the client. So these are going to be at the very top of your expenses. And these are more malleable, I'd say, these expenses that come below it. These are, up to quotes. You get a quote for installation if you hire a subcontractor, for example. So these can be adjusted based on the type of servicers that you hire. So you see that these types of expenses are lower down on the list. And the cost of goods sold is another fancy accounting term for anything that had to be paid for to provide the service. And then after we subtract the cost of goods sold, those necessary expenses from the gross amount of income here at the top, we get down to a total income after the cost of goods sold, which is called the gross profit. And that's what's highlighted here. After subtracting all of the expenses for the individual projects for this design business example, then you have all of the operating expenses or the things that are paid on a monthly basis for the business as a whole, not expenses directed to any given project, but expenses that have to be paid for the entire business. Insurance, umbrella insurance for the whole business, any kind of equipment that's used on multiple projects in this particular business. These are all coming down closer to the bottom of the list. And of course, those all get subtracted, as well as any discretionary expenses that might come up. Here you have accounting and lawyers. For whatever reason, they had to hire a lawyer, $100 to a lawyer for some reason. So those all come off close to the bottom there, because those were things that had nothing to do with a particular project, but had to be paid nonetheless. And then as you see, it gets more and more discretionary. We're down to meals and entertainment. I guess they decided to buy $9.50. They bought their employee a meal at a drive-through, I guess, because that's not a lot of money. But for whatever reason, you got this $9.52 for meals and entertainment, and you see it near the bottom of the list necessarily because it's even more discretionary on the part of the owner. And then the utilities are mostly probably having to do with an office, if they keep an office for the business. So the utilities really have nothing to do with any individual projects either, also at the bottom of the list there. And the other expenses here just are miscellaneous expenses, and you see it's $2,666. Now we'll come back to this, but let's try to click here on miscellaneous and see what comes up there. So these are bills outstanding, and like I said, we're running an accrual type report. So the expenses are going to include bills that are outstanding that we as business owners have not paid yet, but they're still going to come up as expenses for the particular month because the vendor or supplier has already sent out the bill. Now, with these miscellaneous ones, you kind of want to raise your eyebrow and see if you can better categorize them if you can, because miscellaneous doesn't really tell you a whole lot. The important thing about categorizing is we can put it into a proper category and do the types of analysis that it looks from the Q&A that you all are really interested in. You all really want to be able to compare the different line items and come up with a analytic about the health of the business or how the business is doing in any given month. And when you have any kind of expenses that are just miscellaneous, it's kind of a cop out, and it doesn't really say much when you get to the report. So this says insurance agency, so just avoid stuff like this, because if it says insurance agency and it also says miscellaneous, it's pretty obvious that this is an insurance expense. So just change this to insurance. When you see the name there, it can really tip you off. And even if it's not obvious from the name, the owner should be able to tell what this is best matched to, if this is for a particular project, and kind of work backwards. A little reverse engineering goes a long way to find the proper category for these. And you can always change these individual categories, like I showed you, from clicking on the total amount in the report, and it takes you back to the individual transactions that make up the amount. So you can change these if necessary, even after you're in the report. Even after you reconcile, since the reconciliation has nothing to do with the categories, you can always change the category at any particular time if you ever decide later that you're mistaken about a category, or you think a different category of account is better for a particular income or expense line item. Click back to the report list. There in the upper left corner, we come back to our report. And again, we're in the accrual report, and we're down to a net income of $1393.32. And I've already showed you from the cash report that it's going to come up different if you have outstanding invoices or bills. Now, I think there was a question. Let me see if it'll come up for me. Yeah, it was about the numbers and what they can tell you. Typically, you want to look at your what are called cost drivers when you're looking at your profit and loss or your income statement. You want to look at your cost drivers and compare them to your total revenue and see what's costing you the most money, and then ask yourself, should that particular cost driver be costing that much compared to your total revenue? For example, here, we have the total amounts billed, because we're on the accrual report. We have the total amounts billed for this particular business: fountains, plants and soil, sprinklers. It's coming up a lot more than the income that's coming in. So when you see a difference there right off the bat, you ask yourself, did we have a lot of projects that we haven't billed our customers for yet? We have a lot of brand new projects that we had to go out and spend a lot of money on. Do these numbers make sense comparative between what's been paid out and what's been received for this month because of what's going on? Or are we paying out a lot of money for projects that we should have already been receiving money for? Now, you're spending a lot for, I can just give this company as an example because every company is unique, but they're spending a lot on plants and soil. They're spending almost the same amount as design income. So that might be something to go look at and make sure, you know, our suppliers of plants and soil, are they charging us too much? So really, it's just a comparison between the total income number, the revenue number here, and any particular expense line to see if that number is going to persist from month to month, or if it's kind of a one-off. The most important calculations are really making sure that the cost of goods sold is the highest type of expense, because like I said, it's the most pertinent, and that's why it's closest to the top. You want to be spending the most of your expenses for any given customer or client in cost of goods sold for most retail businesses and the service businesses where you have to provide products when you're performing the service. Say you're an HVAC contractor and you buy the HVAC unit for the customer, and then you bill them for the HVAC installation as a whole, then much of what the client pays you, obviously, or the customer pays you, is going to be going towards that HVAC unit you had to buy. So those drivers should be the highest. They should be at the top compared to the expenses that come closer, that are down the list, that are umbrella expenses that apply to the entire operation as a whole. Those, when they're spread out, should consist less of your expenses per customer compared to the cost of goods sold. And I'd say that as you get down the list, the numbers, generally speaking, tend to decrease. Not always, but those numbers should tend to decrease on a per customer basis or on a per revenue basis. So if you know how many customers you have, you can divide the revenue up per customer, and then look and see how much you're paying, like for an umbrella expense like insurance, see how much insurance you're paying per customer. That number per customer should be lower than the cost of goods sold or services provided that you had to pay for that particular customer. So those are some general ways that you can see if you've had a good month, or if you have problems with your expenses being too high compared to the income coming in. The industry average, I mean, you could Google industry averages. They're going to be very general. I don't really want to give a chart for industry averages because those can be very nuanced, and even with the useful lives that I did last week, it gets even more subjective than that. Generally speaking, though, if you have a retail business, you're going to see that you're going to see that the cost of goods sold numbers are going to be very high compared to your total income number, and your margin or your difference between your income number and your cost of goods sold number is going to be pretty low. And that is pretty normal until you're able to widen those margins. So typically the margin is no more than 10%. You wind up spending most of what you receive from your clients or customers on what you provide to your clients or customers. With service businesses, of course, you're going to see a much wider margin, but still, when your expenses start to creep up, you should always be asking yourself from month to month, are those expected to increase? Was there a cost increase that we didn't notice? Or is this just a one-off month because we've done a lot more for the business, but we haven't billed our customers or clients yet? Those are the questions you should be asking yourself every month to make sure your company stays healthy, so to speak. Okay. So like I said, these all tie into the balance sheet. So once we do tie that into the balance sheet there, you're going to take the bottom number and it's going to flow into the balance sheet, and it's going to get totaled to an account called retained earnings. And retained earnings, like reconciliation, is another term that gets thrown around a lot, and people have heard it a lot but don't quite know what it is. It's just your retained balance from month to month of anything that you got to take home. But subtracted from your retained earnings are anything that the owner takes out for their personal expenses or for their quote unquote compensation from the business. Obviously, the purpose is to make money and then to take out that money from the business account so that you can go live your personal life with it. And so we have this net income number coming in at the bottom. That number gets added to your total retained earnings that persists from month to month and get added to your retained earnings on the balance sheet. And then as you take money out, there's an account in QuickBooks, an equity account, as I mentioned before. The equity is the profit interest of the owner. There's an equity account called owner's pay and personal expenses, which reduces that retained earnings account as you have money in it from your ongoing net income there. The owner's pay and personal expenses is also called owner's draws. That's also an account name used interchangeably. So whenever someone refers to owner's pay or personal expenses or owner's draws, they're referring to money that was retained in the business from the ongoing positive net income from the business that was removed so that the owner could pay himself or herself. Owner's draws or owner's pay or personal expenses. You should see those automatically. When you start a new company in QuickBooks, you'll see those already available so that you can categorize appropriately in the banking tab when you see amounts spent that were ATM cash withdrawals or the owner paying himself with a check made out to cash, for example. You can properly categorize that as owner pay or personal expense. So that said, let's go ahead and run the report list here again. And again, in the upper left corner, there's a tiny little blue link. And if you click that, it's kind of like a back button, and it'll take you back to all our reports listings here. And we have a balance sheet one here. So let's see what this says. Always scroll up and make sure the period that you're looking at is correct so that you have consistent information. It wants to always give you the year to date. So you just want to change this back to, again, last month because of the profit and loss statement we were looking at July. So let's run the accrual report for July. Make sure that we see all of our invoices from our customers, which I mentioned in previous webinars is the accounts receivable line there. So accounts receivable, as you run invoices in the sales tab there on the left, you add invoices. those invoices that you enter that have not yet been paid from customers, this will increase your accounts receivable account, 528,152. And so if we change this to cash, and we'll notice that the accounts receivable line is gone because the cash balance sheet is only looking in at what's coming in cash, actually coming in as cash. So accounts receivable or invoices that have already been paid by customers in the given month, or amounts that have actually been paid to vendors that have already been paid on a bill. So when you do a cash balance sheet, you're going to see that the accounts receivable on the income side, that line item's gone, and you're also going to see the accounts payable line on the liability side is also gone, because the accounts payable line is the outgoing bills that have yet to be paid to vendors or suppliers. So, and I just ran the accrual report again, and you'll see towards the halfway down, accounts receivable comes up. So this 1602.67 is the amount that has yet to be paid to bills outstanding. We received a bill from vendors or suppliers, but we haven't paid them yet, and so this is what we still need to pay on the bills outstanding. Now, there's also a method to the madness with the balance sheet as far as the ordering. It's usually order of liquidity, and liquidity is just the amounts, the types of accounts that can be most easily converted to cash starts at the top. So that said, we have the cash accounts at the top because these amounts are already cash. We have the bank accounts. You're not going to see credit card accounts at the top because lines of credit aren't really assets. Really, you're just going to see anything related to credit cards. As you go down and you see the liability side, you're going to see the amounts that are outstanding on a credit card that have yet to be paid. So just remember that lines of credit on credit cards or otherwise aren't really considered resources or assets because they're subject to be changed by whoever's providing them. The bank or the credit card could call you at any time and tell you, we're not going to extend you this line of credit anymore. So it's not considered a resource to be relied on. So you're not going to see the lines of credit for credit cards or otherwise and the assets. You'll just see the amount outstanding on the credit card under the liability section. So as I mentioned, the liquidity has to do with the assets that are most easily converted to cash. So right after the cash balances, we should have the accounts receivable because those are the ones that we really expect to be paid first. There's really no point to being in business if your customers or clients aren't expected to pay you. So ostensibly, we want the accounts receivable to come very next and be the most liquid compared to the cash accounts. These are the amounts that we can rely on that will be paid by the customers, unless we have some really bad customers that aren't going to pay. And then we have another problem on our hands with bad debt, which I think that'd be another good lecture series, is just going over bad debt. But that said, we'll just assume that all our customers are good customers and that they're all going to pay us, so we'll put all that there for now. And the other current assets, this inventory asset, this is going to pop up when I showed you last week the sales tab. We had products and services. So if you have a retail business, this will pop up and change whenever you have an invoice going out to the customer. It'll decrease your inventory on hand, which will decrease the value of the inventory you have at any given time. So this inventory asset number is tracked by whenever you add product inventory or services, or you send out an invoice and you put the amount of units, the quantity of units that were sent out to a customer, it'll adjust this number accordingly as well. And the undeposited funds are any amounts that have been paid already, but we just haven't put them in the bank account yet. Since they're not technically in the bank account, like they're in a petty cash drawer, for example, they're amounts that have been received, so their invoice is paid, but we can't say that they're in the checking account yet because they're not physically in the checking account yet. So that cash is put closer to the bottom, but we can expect that this amount is eventually going to be added to the checking account there, along with the list of all the other deposits that were made to the checking account. Let's see what's in the Q&A here. As an aside, yeah, taxes are different, as I explained in the last lecture, but there is a write-off for bad debt, of course. The tax code doesn't obligate you to pay for income or pay tax on income that you didn't actually receive. So if the bad debt ever becomes definite, if you have a receivable or an invoice that's been sitting out there for months and months and months, and you know this customer is never going to get around to paying you, and you know that to a certain degree of certainty, there's specific rules about that, but I'd say if you had an invoice that was supposed to be paid in 2 months' time at the very latest, but they've waited 6 months to pay you, and you have some assurance that the customer is never going to pay you, maybe you know the customer is going through bankruptcy, and you're able to verify something like that to a definite certainty. To that extent, you can definitely not include that bad debt in income on your tax return. So that's the answer for your tax write-off for bad debt. It's just about how much income you actually have received on your tax return. And just as an aside, the tax return is on the cash method. It's not on the accrual method for most small businesses. So again, you're not going to be including accounts receivable on a tax return either. So it's not a write-off. It's just more not included because you didn't actually receive it from the customer on the tax return. Jaylene asked about packaged goods and how should you label third-party payments. Third-party payments are going to come in from PayPal to your checking account usually, unless you keep a running balance in PayPal. And I think you can, I might be mistaken, but you might be able to add a PayPal account to, I've always had my clients that have PayPal, I've always had them linked to a bank account or a checking account because it's free. But I think there's capability with QuickBooks on PayPal, but let me get back to you on that. I'm not entirely sure. You may be able to link a PayPal account if you have an outstanding balance. You may be able to link it directly to QuickBooks. But if not, then you can always link your PayPal to your business checking account and then periodically do a transfer from the PayPal balance. And then the reconciliation would be exclusively with the business checking account. And the transactions that come through like a PayPal method, those always can be just added manually if you have them. But I'm pretty sure there's a way that you can add the PayPal account like a bank account because it functions a lot in the same way. So third-party payments that were paid through PayPal, yeah, I think they function like a bank account. But I will definitely send a follow-up about that. All right, and then as far as what the balance sheet can tell you about the health of the company, you definitely want to keep your assets more than your liabilities or your equity, or your assets more than your liability. Your assets should always equal your liability and equity. So you'll notice that for total assets, we have a matching number to your total liability and equity. But at first glance, you just want to make sure that your assets stay more than your liability. There's a term called solvency. And what that means is if you're solvent, it means that you have more assets than liabilities. And as a going concern, as a business that stays healthy, that's what you want. You don't want more debts outstanding than you have resources on any given date. that's usually a bad sign that the business isn't going well when you have too many debts compared to your assets. So you want most of your assets, since assets are comprised of either liability or equity, as I explained before in previous webinars. You want to make sure that the predominance of your assets, if you can, be from equity or be from ownership interest, either from the owner himself or herself or third-party owners that have invested in the business. Those are usually the best origins of assets as opposed to debt. Sometimes you take on debt to expand the business, but you want to use that sparingly. So that's really what the balance sheet provides, is some information about where your assets are coming from, where your assets have come from on any given date, and just to make sure that your assets are coming from too much debt. And so if you see, there's a total liability line here and there's a total equity line. So the total liability line, it says 31,131.33. And so for this business, we'll look at your total assets here and we'll see, aha, it looks like your liabilities are really high compared to your assets. So this tells me either that it's a brand new company that took on a lot of debt to start the company and they're hoping it's all going to work out and sort of crossing their fingers, or maybe they're a few years in and they have just slowly fallen further and further behind because they weren't paying attention or didn't have enough customers to keep up with their expenses for whatever reason, and they just were taking on too much debt. And so this would be a bad sign if you saw this. You saw liabilities being so much higher than your assets. You want to look further into how or why that could be, and try to reduce your liabilities whenever possible. And then, big accounts, obviously, that are leading up to the liability line, focus in on those. Like, why did they take out a $25,000 loan? Was it to buy a particular piece of equipment? I see they have a truck, but the truck they bought was a lot less than that $25,000. So what was that $25,000 for? So you just use these numbers to ask follow-up questions. And of course, whenever you see the blue link pop up next to the dollar amounts, you can click on those to drill down to the transactions and get to the date of the transaction, the vendor that was paid, or the bank that you felt obligated to on the note, and find out, what exactly was I paying for and why? Was this a foolish decision, or did I have a real plan for this? And so the income statement flows into the balance sheet, and now you have on any given day what your balances were. And your accrual is going to be more informative. It's going to include your accounts receivable and your payables. Let's see if we have anything else about balance sheets or income statement. Hi, Jillian. And so you suggest cash or accrual for e-com. With e-com, you're going to have commerce, so it's going to be retail. You're going to have wholesale, and I imagine you don't pay those wholesalers right away. You might pay those wholesalers at the end of the month, or they might even give you a longer term to pay them. If that's the case, I'd recommend accrual, that you just stick to accrual all the time. That's probably going to be the most informative with your bills that you have outstanding from your wholesalers. And that is true even if your customers pay you right away and you really don't send out invoices to your customers, because usually with e-com, if it works similar to eBay, for example, the customer has to pay you before you it's payable on delivery, right? So the customer has to pay you before you send the product. But even so, stick with accrual so that you can track your outstanding bills to your wholesalers more accurately, I would say. And then lines of credit, the unused balance lines of credit, it's not a liability. The liability is only assumed or accrued, as the saying goes, when you actually take on that liability and you actually use some of that line of credit. So just keep in mind that it is something you need to keep track of, your lines of credit, but because they're subject to adjustment, and being subject to adjustment, I mean that they can be changed by the bank or the credit card company, whoever is offering the line of credit. They can call you up tomorrow if they want to for no reason, whatever. They don't have to provide a reason and say, we're not going to provide this line of credit to you, or we're going to reduce it by $10,000. And there's really no recourse. You just have to kind of accept that they don't want to offer you that line anymore. And so it's not really reliable to the extent that you can call it an asset. And it's not a liability because you haven't really used any of it yet. You don't have to pay anything back on that line of credit. So it's good to keep note of it and keep track of it, but a line of credit that is unused as of yet is not going to be considered an asset or a liability. Okay, and I think that's it for our Q&A about the balance sheet. So let me roll into cash flow and see how much of that I can cover. Cash flow is probably the trickiest compared to the three, but it is important, especially if you have an accrual business where you have outstanding invoices to customers, or you have bills outstanding that you still need to pay in any given month to vendors or suppliers. The cash flow can keep track of how much cash you have at any given point in time, and make sure you don't fall behind on your cash flow compared to your income. Now, when you have outstanding invoices to clients or amounts that still need to be paid to vendors or suppliers, you could have a situation where your company looks really healthy on the income statement or on the balance sheet. You could have a lot of invoices that you've sent out to customers, and you're confident that your customers are good for them, that they're eventually going to pay them. And so, we're going to call all those outstanding invoices revenue, but we haven't received any cash from those customers yet. And so if you do that a lot and you say, oh, customer, pay me in a couple months, I know that you're good for it, so we'll just call it revenue for now, and when we get around to it. If you fall in that habit a lot, and there's good reason for that oftentimes, but if you fall into that habit a lot, you might have some trouble with your cash flow. You might have some trouble where you need to pay on a particular debt. So you need to make a payment on your credit card, or you need to pay something on demand that, there's a supplier that doesn't offer you a line of credit, so they want to get paid right away for a supply that you need right away, but you find you don't have cash, but you have all this income, you have all this revenue because you have all these invoices out that are, accounts receivable waiting to be received. So you thought your company was doing well. So that's what the cash flow statement is for. It's just to keep track of your cash that's coming in and out in any given month, so that your supply of cash on hand doesn't get so low that you run into problems with being able to pay your obligations that need to be paid on demand that you can't wait to pay, that you don't run into trouble where you can't pay those in any given month just because you're short on cash, even if your income's blowing up and your business is doing really well. So again, make sure that your report period is right. It's always need to do that. And we'll run the report again, July. Okay, and this is going to be the difference. And I said it was kind of tough to understand because everything is going to be backwards. This is what's called indirect. So they're going to start and do some reverse engineering to back into what cash you receive from every given part of your company. So everything is going to be the opposite. And that's why it's kind of a dyslexic's nightmare, because it's not what you would expect. You're starting with your net income number. And this net income number is the one that's at the very bottom of that income statement that I showed you a little while ago. So at the end of the day, after all of our bills that we received from our vendors or suppliers, after all of our invoices we sent out to customers, we have a bottom line net income number of $1393.32. Of course, that is not the cash we received from the month, because our invoices that we sent out haven't been paid yet, and our bills that we've received, we haven't paid all of those either. We might have paid some of them, but not all of them. So we need to back into what our cash provided from the operating part of the business is going to be, based on reversing out all that non-cash events that took place. So as you can see there, subtracting out all the accounts receivable because we haven't received those in cash yet. We've sent out invoices and we're expecting our customers to pay us in the future, but we can't rely on that as far as our cash flow. So we need to subtract out all the accounts receivable. We need to subtract out all of the inventory asset because, again, not a cash item, not something that's going to result in cash, even though it does increase our income. And since we get to defer our expenses and we don't pay those yet, we get to add back all the expenses. So the accounts payable or the bills that are outstanding that we have that have increased our expenses, but we haven't had to pay out yet, we get to add those back to get to our cash flow number, in addition to all of the stuff that we paid for with our credit card. Since we didn't have to pay cash, we get to add that number back that is outstanding on our credit card too. And all these other payable numbers too that we had to increase our expenses for in the income statement. We didn't actually have to pay them in cash, so we get to add them all back in addition to that. So on a net basis, we take our net income and make all these adjustments. We get down to the cash that was actually provided for the business. So this is the number, when you're using an accrual method on accounting on the income statement, this is the number coming in as a positive that is cash coming in to the business. And so as you'll see, it's a very healthy number. It's higher than the net income number. And when you have a lot of invoices or bills that have yet to be paid, you want to make sure that this cash provided number from operating stays higher than the net income number as a general rule. Once in a while, it's okay for it to dip below the net income number if you have, just a lot of invoices outstanding in any given month. But check every month and make sure that 9 times out of 10, I would say, for the most part, your net cash provided from operating stays higher than your net income number for any given month. And these other ones are easier to understand. These are just amounts going out for different kind of investments in the business. Like if you buy a big asset, like in this example, a truck, your cash had to go out to pay for that. So this is telling you that $13,495 was paid in cash to buy a truck. That's pretty good that you can afford to do that. But in this example, anyway, that's what this says happened, that they spent $13,495 in cash, available cash to buy a truck. That's what that's telling us. And the financing, as you'll see again, you have a note payable. So we bought on credit, or we took out a line of credit, and we got a bunch of cash on a line of credit that we, even though we now have to pay back, it provided us $25,000 in cash on a loan. So that is a financing resource that's going to increase our cash flow by $25,000, even though it's a note we got to pay back in the future. And it's not good to take out that kind of debt, in my opinion, without having a reason, because you got to pay it back at some point. It, at least for this month, is going to increase our flow of cash by that amount. And this opening balance equity is just tracking how much was paid into the business at the very beginning. It's saying that much was provided to the business in the beginning, that was paid right away for other things besides cash. So that's why that number is negative there. And so on a net basis, after everything you paid for up front for the business, that took the money out of the cash of that $25,000, that's why it's giving you a net balance there. And then the cash at the end of the period at the very bottom is just combining these 3 line items: the net cash provided from financing or lending activities, debt, taking on debt, the investing activities, or putting cash into the business to invest in certain assets, for example, and the amount from the ongoing operations are actually performing the business. These are the investing and the financing going to remain pretty static. Every month, you don't want to be going out and taking out big loans from banks or buying big pieces of equipment. So these will remain relatively consistent from month to month. In the average business, this number will fluctuate dramatically, if you can imagine, because this is totally dependent on your relationships with your clients and with your vendors and suppliers. and you wind up with a net number again, keep this number in the positive, and you'll always be good, even if it's a small amount in the positive, even if it's not almost five grand like this one is. As long as it stays positive and you don't see consistent negative numbers from month to month, that's a healthy sign that you're doing well on your cash flow, despite what's going on your income statement and your balance sheet. Hi, Julie. Yeah, the net income line, it comes from the bottom of your income statement. So it says it's 1393.32 in this example. So if we go back to our report list, and we click on profit and loss, make sure you're looking at the right period. Go back to last month. We'll run the report. You'll see at the very bottom, it's the net income 1393.32 after accounting for our invoices that have yet to be paid by our customers and all our bills that are outstanding that we have yet to pay for that we've received from our vendors and suppliers. We get to our 1393.32 number. So we'll start with that number, and then we'll back into the cash flow number by making certain adjustments based on line items from the income statement. All right, I'm surprised I got through all that, but Morgan, it looks like we got through all three statements there. So I'm glad that I was able to, and I'm figuring out how to answer the questions on my own too, which is good. Instead of you having to interrupt me and say, Jay, there's 10 questions in the queue that you still need to answer. I'm able to actually find them this time.
Awesome. Yes, thank you so much. I think we have another one that just rolled in as well. Could you please explain the difference between a discount, write-off, and a bad debt?
A discount is just an amount that's given to a customer as kind of a treat, either because they're paying early. Sometimes companies give a blanket discount to every customer. For example, if they pay their invoice, 10 days before they're supposed to, they'll give them a 2% discount. Or sometimes they'll have a retail number that they show on their price list for whatever service or product that they're providing. But they're saying, today we're having a special, so we'll give you 10% off. Those are a couple of different examples of discounts, which can be accounted for and put on a separate line. As you'll see on this example, the second line down, it says discounts given. That's given to individual customers or blanket discounts for paying early on invoices, whichever. Those get taken right off the top because while they're not a part of your official price list, they are accounted for right away and are part of your gross revenue before accounting for any expenses. And so that's why they're taken off right away. Write-off is typically for taxes. When we say write-off, they're talking about taxes. So another attendee at the last lecture was asking about write-offs, and I think there was a confusion between what's an expense and what's a write-off. An expense term is typically only used for bookkeeping purposes, and again, for income and expenses and those types of terms, we're looking at the bookkeeping and allowing the owner to keep track of how the health of their business in any given month with the balance sheet, income statement, and cash flow. With a write-off, you're asking, is this tax deductible? Meaning, is it going to reduce my final taxable income so I can pay less tax liability to the IRS, to the state, or to the local government because of a provision in a statutory code that the legislature comes out with saying, we're going to give you this kind of incentive to, for example, buy a big asset. There was a recent famous tax law change in 2017 that gave a lot of incentives to buy big ticket assets because they wanted business owners to go out and invest in their businesses and buy big pieces of equipment. So they're saying, we're going to let you write it off all at once. And so that's the term write-off, and where that comes from. It typically is talking about taxes and what you can write off as far as reducing your taxable income and thus your tax liability. And bad debt is something I went over briefly today, but That's used also, it's used also in taxes too, because it refers to the same thing. It refers to your doubtful accounts or your invoices that you have outstanding to your customers that have not yet been paid, but they've been outstanding for so long and they're so past the due date that you don't think that that customer is going to be ever paying you. And so at some point you need to expense that. And there's a way that I can go over in a subsequent webinar here how to properly expense those for bookkeeping purposes. But then once they get definite enough, then you can also write them off on your tax return. Yeah, the bad debt is a term that's used in both bookkeeping and in taxes because it's relatively the same. And then the webinar on the chart of accounts. Yeah, I touched on the chart of accounts in the beginning, and I think it was the first webinar I did that I did a lot of the chart of accounts questions and everything. But I'm happy to go over the chart of accounts again in a subsequent lecture if we go over bad debts, for example. And there's an account that goes with bad debts called the allowance for doubtful accounts, where you're going to estimate how much bad debt you're going to get from your customers compared on historical averages and things like that. And I'll show you how to set that up. And then we can dive deeper on that type of webinar into the chart of accounts and what it all means. But Jaylene, if you haven't looked at that first webinar that I did, it was not the fundamentals, but the first one about the Ask Me Anything session. I think I did about 20, 30 minutes on the chart of accounts. So if you haven't looked at that webinar, check that one out. But yeah, I'm hopeful that I'm going to be able to do another webinar similar to bad debts or something where I can go delve into chart of accounts further. Yeah, the links to the past webinars, Morgan's posted them, and I'm sure in the subsequent emails she'll probably post them again. They're on YouTube on the subscriber channel for PCV, so you can just subscribe to YouTube or wait for the links from Morgan. If an investor was going to look at my income sheet, what lines are most important? A smart investor is going to look at all three because they're all related. The income statement, the balance sheet, and the cash flows. They all tell a story of your company, and they're all invaluable to what they tell. But if they were to just look at your income statement, they would really look at your gross revenue and what they really want to know from the very start. If you've ever seen Shark Tank, they always ask, "What's your revenue number? How much money do you have coming in?" The expenses can be adjusted by finding better suppliers, by finding cheaper suppliers, finding more efficient suppliers. You can always work with your vendors or your suppliers or your people that you pay expenses to and that you receive bills from. You can always work with them to lower your expenses, but you're nothing if you don't have a healthy gross revenue number. So I say if there's one thing that an investor is going to look at, if they're going to provide you money for equity or future profit interest, or to even give you a loan, they're looking at your gross revenue. How much money do you have coming in from your customers on any given period?
And there's also one question that came in from the chat. Hector, he's saying he's an owner of a small business that's hurting because of COVID. And in the past 6 months, he's not received any kind of help. Do you have any advice as far as receiving financial support?
I've heard a lot of good things about the PPP loans. I know a lot of them are forgivable. If you haven't looked into that, I highly recommend that. I hope the deadline isn't passed. I'm sorry, I'm not an expert on the PPP loans. They're relatively a new thing that they sent out. Congress sent out an emergency statute about that, and I haven't had a lot of my clients are all going concerns that fortunately, knock on wood, didn't suffer too much because of the pandemic, because they mostly deal with like residential areas where people are staying home more, so they just lucked out because they were in a type of business that didn't suffer. But if you're a restaurant or something, I really feel for you. There was another topic I was gonna also go over with the follow-up email. Sorry, Morgan, could you help me out? I mentioned I was gonna send out some info. I'll probably remember it after this, but I was gonna.
You mentioned the PayPal connection.
Oh, that's right. Yeah, I'll look
Yes.
out the PayPal connections on the banking tab, and then also PPP loan, if I can find anything in the next 20 minutes or so about if you can still apply for those or when they expire. Yeah, definitely look into that, because I know one thing I do know is that at least a portion of it is forgivable. And I think that's the best way to get help from the federal government anyway.
We got some comments saying that we think that the deadline has passed for the PPP loan. It expired on the 8th of this month. But what I can do as well is we had a separate webinar with another one of our advisors on kind of accessing financial support during this time. So Hector, I will share out some of the resources that PCV has as well to help you out there. Great. And are there any other questions? I think we've, I'm checking our Facebook page. I don't see anything new there. I don't see anything new in the Q&A. I think we addressed everything in the Zoom chat as well. But we do have a couple comments saying, thank you so much, Jay. Jay's webinars are awesome. We hope that you come back. So thank you so much on behalf of everybody in the PCV community. These have been so informative and so helpful. We have one more with Jay scheduled for next week, and it sounds like we've got a couple ideas for future topics. Should Jay be available to join us later on this year, we'd be happy to have those as well.
This is most fun, and I'll see you all next week, and I will get you an answer to the PayPal question here promptly, Morgan, so that you can send out that follow-up email to everybody.
Perfect. Great. Yes, like Jay said, I will send a follow-up email soon with the recording with some last-minute answers that Jay's going to provide on some of these questions that we didn't have concrete answers for you on. And as well as all the links to his previous webinars, all the links to our future webinars, should you want to join us with that. But I just want to close out by saying thank you so much for joining us today, and thank you again, Jay, for spending your time here with us this afternoon.
You're almost welcome. Thanks again.
Enjoy the rest of your weekend. Thank you.
You too. Bye.